Corporate wellness apps and carbon tracking platforms capture thousands of daily commutes, but the data is entirely self-reported. An insurance actuary or a municipal bond underwriter cannot legally stake capital on the honor system. They require statistical certainty, not user-submitted survey results. This creates a rigid authentication gap between what a mobile app records on a consumer device and what a financial auditor accepts in a boardroom. Because the inputs lack cryptographic proof, the resulting dataset is a speculative vanity metric. It cannot defend a legal claim or satisfy a rigorous compliance audit. Without strict verification, these databases represent an institutional sunk cost. They cost money to administer, but generate zero monetizable financial return. The value in behavioral data is never inherent. It is activated strictly through cryptographic verification. The VIDAT system operates as a 5-layer verification engine designed to close the authentication gap. The sequence begins at the identity layer. The writer taps an NFC-enabled credit union card to a smartphone, establishing a secure link to a financial identity. Moving to the validation layer, the system requires a scan of a registered bicycle tag and confirms session completion at a destination node. The output is an actuarially defensible dataset known as the truth baseline. The physical action is proven and tamper-resistant. Establishing this truth baseline mathematically transforms a single physical commute into 3 distinct, non-correlated institutional yields. Insurance companies assess risk using rigid standards. When underwriting corporate healthcare plans, they must estimate future claims across an entire workforce. Because insurers cannot distinguish the specific health behaviors of individual employees using generalized tables, they must hold a margin for adverse deviation. This is a surplus of capital locked away to cover the statistical uncertainty of the population. This circular pool represents insurer healthcare reserves. Actuarial Standard of Practice number 25 governs exactly how actuaries can adjust these models. Under ASOP 25, an employer can provide fully credible subject experience data, like months of cryptographically verified commutes. The actuary substitutes this specific data for generalized industry tables. As verified behavioral data enters the model, statistical uncertainty drops, and the required margin for adverse deviation shrinks. The capital previously trapped in the reserve margin is liberated and flows back to the self-insured employer as a reduction in healthcare premiums. For a mid-size self-insured employer, this actuarial mechanism is projected to release approximately $340 per active rider per year. A standard corporate wellness program goes from an HR cost center to a direct driver of corporate liquidity. At the same time, corporations face rising legal pressure for auditable ESG and Scope 3 emissions reporting. The core challenge in the voluntary carbon market is proving additionality. A carbon credit is only valid if it represents a verifiable behavioral change that would not have happened otherwise. A cryptographically verified commute proves additionality because it demonstrably documents the specific displacement of a motorized trip. This is a comparative bar chart showing the baseline calculation logic. An internal combustion engine vehicle emits roughly 440 grams of CO2 per mile, while a bicycle emits about 34 grams. The system verifies an avoidance of exactly 366 grams of carbon per mile ridden. This precise metric is packaged into a bicycle commuter carbon avoidance credit, meeting the rigorous standards of Scope 3, Category 7 reporting. Under mandates like California's Senate Bill 743, this verified vehicle miles traveled reduction satisfies strict legal standards required for project approvals and green bond structuring. Speculative carbon tracking becomes a hard compliance asset for corporate sustainability officers. Local financial institutions face a different underwriting challenge. Credit unions struggle to issue loans to thin-file members who lack traditional credit histories. Returning to the primary verification sequence, we look at the hardware financial sync. The initial NFC tap identifies the specific credit union sponsoring the deployment, tethering the rider's identity to the specific vehicle. This process securely links a physical activity session directly to a regulated financial account. Months of consistent commuting routines generates a highly documented behavioral record, serving as a data-rich proxy for financial reliability. This allows credit unions to issue zero-interest e-bike loans through Slingshot, using verified daily behavior to underwrite risk instead of relying on traditional FICO scores. The institution drives low-cost member acquisition while simultaneously securing documented compliance with the Community Reinvestment Act. 3 entirely separate institutional markets, healthcare, carbon compliance, and consumer finance, are simultaneously monetizing the exact same verified bicycle commute. This architecture generates a fourth yield stream, a reverse licensing royalty paid to hardware OEMs whose wearable devices and e-bikes provide the sensor telemetry. The system is sustained by clear compensation logic. The employer captures the largest financial return by securing the $340 per employee healthcare assistance. The employer takes a fraction of that actuarial return and uses it to fund direct monthly wellness stipends for the commuting employees. This stipend transforms the employee into an active, compensated participant with a direct financial interest in maintaining the verification streak. Aligning the financial incentives of the actuary, the employer, and the rider creates a highly resilient, self-funding data generation loop. Why must institutions adopt this specific verification standard over the methods they currently use? For actuaries and ESG officers, incorporating the highest available tier of data is a strict professional obligation under their licensing standards, not a discretionary preference. Once this cryptographically verified data exists and reaches full statistical credibility, it structurally replaces unverified survey data entirely. To actively exclude this truth baseline from their models, an actuary would have to provide written, documented justification to state regulators, explaining why they chose to rely on less accurate data. This is the compliance moat. It is a structural business advantage built entirely on the legal liability of financial professionals. The VIDAT system converts a verified physical action into a fungible institutional asset. This framework shifts ESG and corporate wellness from unmeasurable cost centers into precise actuarial yield participation models. The institutional value of raw behavioral data is never simply inherent. It becomes real and exists only through cryptographic proof. Capital is not purchased. It is strictly activated through verified use. The future of institutional sustainability and healthcare economics belongs to those who control the truth baseline.